Good morning, it's Friday the 6th of October here in London. This is the Bloomberg Daybreak Europe podcast. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, corporate giants struggle to end their addiction to debt as borrowing costs rise.
Reports suggest that the former President Donald Trump shared secrets about US nuclear submarines with a friend.
Plus a $2 billion headache while Sweden's real estate crisis is threatening its biggest pension fund.
Let's start with a roundup of our top stories.
Figures compiled by Bloomberg reveal the global bond drought is giving corporate borrowers pause for thought, at least for now. This after big companies have racked up hundreds of billions of dollars in debt, which is now getting much more expensive. Chris Pitt has more.
Data from Bloomberg Intelligence shows companies with investment-grade credit ratings have added more than $500 billion of net debt since the first rate increase last year. Even companies with shakier finances have ratcheted up their borrowing after scaling back in 2022. The debt boom indicates that Jerome Powell and his colleagues may have to keep pushing up rates to break the fever and curb the behaviour. The spike in 10-year bond yields over the past 2 weeks has cooled the debt sale frenzy for the moment. A possible sign that executives may now be waking up to the implications for their businesses. In London, Chris Pitt, Bloomberg Radio.
Well, longer-term interest rates have been on the rise since the Fed's September meeting as markets adjust to the message that rates are likely to remain higher for longer. But the San Francisco Fed President Mary Daly, in a Q&A with Bloomberg, suggests that the recent jump in bond yields offers a reason to hold rates steady now.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
Daly's comments in a conversation with Bloomberg's Lisa Abramovitz come after the yield on 30-year treasuries touched 5% this week, the highest level since 2007. The San Francisco Fed chief also told us that she believes policymakers can hold interest rates steady if the labour market and inflation continue to cool or financial conditions remain tight.
Metro Bank is trying to sell parts of its mortgage portfolio to strengthen its balance sheet. The Challenger Bank's shares have fallen by half after the Bank of England blocked it from changing its capital requirements. The company has held talks with Lloyds and NatWest about selling roughly £3 billion of mortgages, according to Sky News.
The UK's economy is losing steam as interest rate hikes and vanishing household savings weigh on the outlook. That is the view of the Bank of England's Deputy Governor, who spoke at the ECB's Monetary Policy Conference in Frankfurt. Bloomberg's Mark Daniel Davies reports now.
Bank of England Deputy Governor Ben Broadbent says there are now clear signs that the central bank's most aggressive tightening cycle in over 3 decades is dragging on the UK economy. He said economic indicators, including spending on household goods, have weakened quite a lot, and that the job market may do the same suddenly as demand growth slows. He added that demand until now has held up better than expected, but that the war chest of savings built up by households during the pandemic has dwindled. One bright spot, though, business investments in some areas remain strong, but Broadbent says he wonders how long that'll be the case. In London, Mark Daniel Davies, Bloomberg Radio.
Staying in the UK, the Labour Party has taken a parliamentary seat from the SNP in a key electoral test. Michael Shanks won the by-election in Rutherglen and Hamilton West, south of Glasgow, after the previous MP was ousted for breaking COVID rules.
People weren't bringing up Margaret Ferrier. That was old news. The recall petition dealt with that. What people were talking about was 1 in 7 people on an NHS waiting list, people struggling with the cost of living crisis, while the SNP is about division and distraction. They wanted to vote for something different and they've gone out and done it today.
Shanks flipped the seat with a majority of 9,500 votes, a massive 20% swing. Pollsters have seen the special election as a crucial chance to test how well the Labour Party could do in Scotland ahead of a potential general election expected next year.
Exxon is in talks to buy shale-focused Pioneer Natural Resources in its biggest deal in more than 2 decades. It's reported that an agreement could be worth as much as $60 billion and may be completed in the coming days. A takeover would be the energy giant's biggest acquisition since merging with Mobil in the 90s and help Exxon in its goal to become the dominant US producer of shale oil.
There are multiple reports that former US President Donald Trump may have revealed nuclear submarine secrets to a billionaire friend who went on to share the sensitive details with several other people. Bloomberg's Ed Baxter has the story.
The shared information reportedly included how many nuclear warheads U.S. submarines carry and how close they can get to a Russian submarine without being detected. Part of a conversation after Trump left office at Mar-a-Lago with Australian businessman Anthony Pratt, who runs one of the world's largest cardboard companies. The report says special counsel Jack Smith has reviewed the claims. A Trump spokesperson says the DOJ should be looking into criminal leaking instead of perpetrating baseless witch hunts. I'm Ed Baxter, Bloomberg Radio.
Caroline, a story that has us all talking this morning is a column from our Bloomberg opinion columnist Daly about the moral case for no longer engaging with Musk's X platform. This is a conversation I've had with a lot of my friends about the use of the platform, and I mean there's a bigger conversation about use of social media in general and how good or bad it is for you, but I mean Daly lays out really the case for why he's deleted the app from his phone. A story about after a murder in his neighbourhood in
It's really
New York.
powerful, yeah. It's a hugely powerful story that Daly concludes that Twitter is basically incentivising violent content, and he says that it's only going to get worse in order for the former Twitter, i.e. X, to stand out even more to users. So this is the video of an innocent man murdered in New York that has then, according to Daly, been used as fodder for millions of views on X. And he sort of talks about the structure of that, of social networks being moulded by the incentives that are presented to users. And he is, very tough on Elon Musk, very critical of him as leader, saying, that the former leadership of Twitter, when it was Twitter, was at least not trying to make things worse. But he also doesn't, he specifically does not name the account that is sharing this. And he pointed to it as one example of where really horrendous footage is being turned around and kind of used to attract viewership. It's a tough read.
Yeah, and some of the highlighting some of the changes that users feel they've seen on the platform since Elon Musk took over and rebranded then Twitter as X as well. Definitely worth a read from Dave Lee from Bloomberg Opinion this morning.
Now, let's get some more details on our reporting around the boom in corporate debt issuance and what the recent rout in treasuries means for companies. It's been the big bond market story of the week, hasn't it? Our economy and government editor, Jill Deesis, joins us now for more. Good morning, Jill. Great to have you with us. Can you talk us through just the scale of corporate debt that is piling up this year? I was sort of staggered at the numbers. This year alone, the kind of debt pile.
Yes, Caroline, it's truly massive. I mean, you heard Chris run through this at the beginning of the program, but it's really, really worth emphasizing again. Since that first interest rate increase back in early 2022, companies with investment grade ratings, so these are, big ones like Pfizer and Meta, the kinds of companies that are really playing this role in driving the U.S. economy, they've added more than $500 billion of net debt, and that's according to data compiled by Bloomberg Intelligence. I think really the short of it is, look, not only has corporate America displayed very little desire to actually pay down debt that's become more expensive because of these rate hikes, but many of them have actually heaped more of it onto their books. And it's really this reflection of how, we've really had these 2 decades of near zero benchmark rates. The borrow and spend model has become so ingrained within corporate America that even when you've had this really aggressive rate hike cycle, it's really, really just hard to put the genie back in the bottle.
Jill, what's happened then to the appetite for debt since we've seen yields soaring?
Sure. So, obviously, we've seen that spike over the past couple of weeks in the benchmark 10-year bond yields. That's cooled the debt sale push for the moment. So maybe that's a sign that investors are now waking up to the reality of what's happening here. But in general, I really have to stress that this urge to take on debt hasn't completely wavered yet. I mean, even accounting for the yield spike, September was still one of the busier months of the year. You saw companies raise a gross $124 billion in the bond market. So we're not really seeing that broader, more holistic slowdown yet.
So I suppose what's the concern and what could be the consequences of the accumulation of this kind of debt?
Sure. Look, I mean, the risk, of course, is that, if the Fed is going to continue to push up interest rates, we've got this higher for longer narrative, that's going on right now. But we're also thinking about, whether there's going to be another rate hike in November and beyond. If the Fed ends up going too far with its rate hiking cycle and the economy falls into a recession, those risks are going to really be felt most acutely by companies that are piling on a lot of debt. The Bloomberg intelligence data that we're looking at shows us that the indicators of financial health within investment grade companies has already begun to deteriorate as their leverage was ticking up. We were looking at a key gauge of their ability to make payments known as interest coverage. Over the last year, that's edged lower. We're obviously incredibly concerned about strains on less creditworthy businesses. You've seen some defaults in speculative grade debt markets. Look at real estate and retail. Bed Bath & Beyond comes to mind from earlier this year, for example. And then obviously, there's that concern about corporate upheaval in general. I harken back to the Silicon Valley Bank failing in March, happening after the surge in interest rates was triggering a run on deposits at the regional, at that regional level. So, I mean, there's certainly a lot of concerns here that we really have to keep an eye on, and that I'm sure Jay Powell is looking out for as well.
Yeah, well, in some senses, I mean, is this really what the Federal Reserve wanted to happen? The point of raising interest rates is to tighten the market. Is this an intended consequence?
Sure, yes. I mean, look, I think Jay Powell has acknowledged this even just last week, saying that one of the goals of the Fed in raising these rates is to influence spending and investment decisions. Of course, when you're using interest rates to change that behavior and steer the economy, there's always going to be the risk of just whether people are actually going to listen to you. And I think that at this point, we're really at that testing moment in time as to whether everybody's going to follow suit.
Yeah, absolutely. Jill, thank you so much for being with us this morning. Our economy and government editor, Jill Deesis, there, just sort of talking about the boom in corporate debt issuance in the US.
Well, let's bring you a story from Sweden next. Earlier this week, the chairwoman of the country's biggest pension fund resigned from her position. The fund, Elekta, had incurred $2 billion of losses from 3 failed bets tied to the collapse of Silicon Valley Bank in the US. Now it's facing bigger problems with another investment. Our reporter Luva Lehman joins us now from Stockholm for more. Luva, good morning to you. Why is Sweden's biggest pension fund back in the spotlight then?
Yes, good morning. As you said, Sweden's biggest pension fund, Elekta, with around $100 billion in assets under management, is once again in the crosshairs here. It has made a nearly $5 billion bet, and it's the biggest it has on a single real estate company called Heimstad and Bostad. And that is a landlord, and there is a risk that this bet could sour if the pension giant doesn't commit even more capital. And then you have, of course, the media and the wider public scrutinizing the investment after what happened earlier this year with the investments in the failed U.S. banks.
Yes. So then what's at stake for Elekta?
Well, it is really that it may be forced to throw even more money on an investment that the new management team thinks shouldn't have been made in the first place, as the risk is too high and the reward is too small. Essentially, it's an investment in which Elekta has invested a large share of capital, but it doesn't have so high voting rights in the company.
Are there similarities in this issue to the SVB fallout, which lost Elekta nearly $2 billion?
Well, there are some similarities. Alecta made a huge loss that time around, as you said, on SVB and two other U.S. niche banks. And it's essentially the same strategy that is behind those investments, namely large bets in single stocks. And they have all kind of been affected by the sharply rising interest rates in one way or another.
And then the reaction in Sweden, what are people thinking about this?
There is obviously anger that people's savings are being mismanaged. A large share of the Swedish population, they have private pension schemes through their employers and labor unions. And for in Alecta's case, it's almost a quarter of Sweden's population. Wow. And these people trust that the money is being looked after, obviously, in a responsible way, so they can benefit from it once they retire. And here in Sweden, people very rarely move pensions, but there was a marked increase of customers leaving Alecta in the past spring, and that could obviously well happen again if this property bet sours.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.
We bring you news and analysis every day on the Bloomberg Daybreak Europe podcast, but now you can hear the latest news on demand whenever you want it. Subscribe to Bloomberg News Now to get the latest headlines at the click of a button. You can listen and subscribe to Bloomberg News Now on the Bloomberg Business app, Bloomberg.com, plus Apple, Spotify and anywhere else you get your podcasts. Search Bloomberg News Now and subscribe today.